every decision we make comes back to how will this affect our clients' well-being. We are a firm believer that economics will take care of themselves if you take care of your client. And the counterintuitive kind of notion that we had is if you make it easy for people to take their money out, they will give you more money because they feel like they have more access to it. We've harvested over $3.4 billion of losses for our clients, which we estimate has saved them $1 billion in taxes. The best way to invest, and this is time tested over long periods of time, is what we offer, just a automated indexed investing strategy. It's not timing the market. People are always worried, am I buying high? Am I buying low? Timing the market is not important. It's time in the market.
Welcome to Tech Finance. I'm your host, Sasha Orloff, repeat founder and current CEO of Puzzle, and self-professed finance nerd. On this show, we dive into the pulse of B2B fintech, from newly funded startups transforming the office of the CFO to major industry shifts, deals, and partnerships that are reshaping how we think about finance. You'll hear the most important developments, essential analysis, and of course, AI innovations. This show is brought to you by Puzzle and the Turpentine Podcast Network. Let's dive in. Hi, everybody. So I am excited to welcome Alan to the show, who's CFO of Wealthfront, a tool that obviously most of you either use or you all know or should be using for that matter. So we're going to dive deep into some of the new product launches that has now shifted Wealthfront to managing $80 billion for 1 million customers. So we're in for a treat for season 2, talking about newly funded startups doing really cool and exciting things, really cool data analysis that's published to the market, and these well-known companies that just continue to innovate and push the boundaries of what's possible. So I'm excited to dive right in. Alan, welcome to the show.
Thank you for having me, Sasha.
Cool. All right. So just in case anybody listening has never heard of Wealthfront, just to go through the process, you guys have been at the forefront of creating wealth building tools for millennials and young professionals. What is the big vision behind the platform?
Yeah, I mean, I would start with the millennial generation, which is a generation we believed in really from the beginning. And they are now actually, after 2019, they've quadrupled their net worth to over 16 trillion. And we actually have that.
Trillion with a T.
That's right, chilling with a T. And they're going to be they're the largest generation by numbers, and will be the first generation to have over 100 trillion in wealth, we estimate by 2045. And so there's a very long secular growth tailwind that we're going to enjoy by growing up with our clients, similar to the way that Schwab did with the baby boomers. The difference for us, though, now is we're a tech driven financial platform helping millennials and young professionals save and invest to grow their wealth. And that's really the vision. And we've, instead of trying to be everything to everyone, we've really targeted those millennials, the young professionals, or what we sometimes refer to as digital savvy knowledge workers.
Nice. Now, do we exclude anomalies like Elon Musk, or is he included in there in the calculations with your teeth?
Yeah, no, he would be included, but I don't think he's on the platform.
Not yet. Let's see if we can change that.
Yeah. One of the things I would point out too is that, what we've been able to do through software and automation is really bring down our costs. And we share those savings with clients in the form of lower fees. So we charge a quarter of 1%. And we share more interest on our cash management account, which is paid by our partner banks. And so by doing that, our clients, they reward us, they give us more money, they open more accounts, they tell their friends. So word of mouth is a really big growth lever for us, which is why it's possible that some of your listeners are clients. And then, because word of mouth growth is a lot cheaper, we are very profitable. And this helps us, again, invest back into lowering costs, sharing with clients, and kind of spinning that flywheel, if you will.
Oh, well, as a CFO, saying the profit word on this podcast, we'll know that's a bit of an anomaly. You've been there for almost a decade. Aside from having cash flow through the bottom line, what do you think has really changed over the course of time from when you first started to today?
Yeah, that's actually a good question because when I started, it wasn't the case, right? So when I started, to give you some specific details, we had around 2 billion in assets under management. We were doing something like 6 million in run rate revenue, and we were not profitable. And there was a little over 100 employees. Now, if you fast forward to today, like you mentioned, we oversee over $80 billion. We are very profitable. revenues, our run rate revenue has grown faster than the growth in assets. So we've over 40x, assets and revenue. We've become very profitable, but the employee count is only like 330 today. So in 9 years, and we've never had a layoff, not in COVID, not in the most recent tech bear market of 22. We've never done a layoff. And that was the business model from the very beginning, was to scale using software so that you don't need a lot of overhead, so that you can run that flywheel I just mentioned. Half of our employees are software engineers, and that's pretty much always been the case. And with our platform and what we've done, we actually only have around 25 people in our product support with no call center or anything like that. And so if you take the million clients, 25 people, there's about a 50,000 to 1 client to product support rep ratio, which when I talk to traditional incumbents in the financial services space, it absolutely blows their mind to hear those numbers.
So this is interesting. So clearly, I was going to start diving into some of the new product launches, but we'll get there in a sec. You've been there for a while. You started in finance. There's probably quite a few things that happened that changed the trajectory to both profitability and product adoption. I remember hearing a lot of sort of skepticism about whether you could sort of private wealth management solution, a digital one or a robo advisor, there's been iterations over time, could ever get to a scale enough to generate profitability. Clearly, you guys are proving that's the case. What are maybe two or three specific things that you changed for the finance org? And what are two to three main sort of products that changed that got you to this trajectory of over 1 million customers and 80 billion under management?
Yeah, so on the latter part of that question, from a product perspective, we have built a suite across the risk spectrum. So it's not just the automated index investing account that we launched with back in 2011. We've both continued to improve that account year after year, but we've added the cash management account, which is extremely popular. We've added bond ladders, which I know we can discuss later, as well as S&P 500 direct indexing. Single stocks can be owned on our platform now. And so if you think about the risk spectrum, we have everything from, highly liquid FDIC insured cash all the way to, highly volatile single stocks. And that's important because you cannot sell, you know, a cash management account as your hero product when rates are 0%. And we've been through that environment. Similarly, when there's a, meme stock craze and rates are 0%, you've got to have a product that meets that environment. And so that's been a really big learning of the company, that, in 2019 is when we first launched the cash management account. And what we learned was having the right product for the right macro is extremely important in order to efficiently scale both clients and assets to get us where we are today. And, one of the things that hasn't changed in the 9 years that I've been here, and I know it predates me, is just our obsession with our clients' well being. Every decision we make comes back to, how will this affect our clients' well being? It's not an, we are a firm believer that, the obviously within reason, the economics will take care of themselves if you take care of your client. And our business model is such that, and maybe, this to your question around how finance has contributed, the alignment of incentives that the business model has with the clients is something we really like and makes a lot of sense. We only get bigger when our clients get wealthier, because we only earn a fee based on assets under management or clients or cash that we oversee. And so we don't have any incentives to push our clients into products that have transactions fees associated with them, or, you know, any kind of transaction activity that would potentially hurt their well-being. And so when we're talking about, well, when should we start charging interest on a margin loan? For an example, that this did come up in a product review where we were sitting there, and the CEO at the time, Andy, said, well, the question came to him as the CEO to make this decision. When a client takes a margin loan out, when should we start charging interest? When we approve it or when they get the money? And somebody who had just joined Wealthfront from the traditional industry kind of spoke up from the back and was like, well, when I worked at so and so firm that I won't name, we would charge it immediately. And I'll never forget, Andy kind of looked back over at him and said, product manager, if that was you, how would you want to be treated? And he said, I would want to, only be charged when I actually have the money. And Andy said, well, then that's how we're going to do it.
As I'm listening to you talk, it's sometimes hard to think and see that you're on the finance team, you're the CFO of the company saying, let's do what's right for the customer because you know you probably could make a lot more money by doing some of the things that the industry has done. How do you as a CFO get comfortable with that type of a product organization?
Well, I think what it comes down to is at the end of the day, we're in the business of trust. And so we don't want to violate our clients' trust. And when you have things like fees, which are less transparent and not as simple, you actually could kind of, you know, shoot yourself in the foot there by squeezing out an incremental few dollars. You may persuade someone to take their assets off the platform and go somewhere where things are more straightforward or they feel more trusted. And so, it's a little bit of a delayed gratification in the sense of, let's do what's right for the client because we're talking about a multi-decade opportunity to grow with our clients. They're on average 35 years old, right? And so they have many, many more years of wealth accumulation ahead of them and new things as they get, more complicated lives. They get married, they have children, buy houses, and we want to be there all along the way. And so it's not about this quarter or this year. It's more of this decade, next decade is how we think when we're talking about strategy.
Any tips for other finance leaders or other founders really listening? How do you stay committed to this long-term vision when you know there's more short-term revenue to be had?
Again, I think the big tip that I would give is, think about your client first and foremost, right? When you think about lifetime value of a customer, one of the biggest variables is retention. And if you retain a client, you don't have to go acquire new ones to replace them, which is a cost. And then their assets leave or whatever their business is if you have a subscription with you. And so really maintaining that client and thinking about delighting them and their well-being, I think is the best way to keep your eye on the long term versus, let's keep our eye on like what are we going to do this quarter relative to what we said and plan. Like we will completely scrap, you know, a plan if it means this is what's in the best interest of our clients.
So you gave the example of sort of fees. Is there any other examples before we talk about some of the new product launches where there's maybe some attention between the short term or long term, or there was a decision to be made? Here's what the industry does, and here's another place where Wealthfront refuses to do that because we don't believe it's in the long term best interest of the customers.
I mean, I would say that if you look at our cash account, our cash management account, one of the things we do is we allow our customers to withdraw 24/7 near instantly, and we do not charge a fee. So pretty much anywhere else you try to withdraw money instantly, you're charged either a percentage of the amount you want up to a maximum amount, and we do not charge. And when we went looking for partners to help us access the real-time payment rails, we got a lot of confused people. Why are you trying to help clients take money out as quickly as possible? They were only working on solutions, the traditional industry, to bring money in as quickly as possible, not let it go out. And the counterintuitive kind of notion that we had, which has come true, is if you make it easy for people to take their money out, they will give you more money because they feel like they have more access to it. And that was something that when we initially came out with our cash management account and it was using traditional next day ACH, people would keep some of their money in their, you know, day to day checking account with a larger bank because they wanted to have access to it. And when we gave them this opportunity to keep all their money earning as much interest as possible, because we allow them to take it out as quickly as possible at no additional fees, that was the trade-off, was like we could charge an additional fee and we'd be just like the industry, whether we wanted to charge for wires, which we don't charge for, whether we wanted to charge for ACH or instant payments. But we said, we're trying to grow this relationship. If you bring us more money because it's better for you to be on our platform, that's the trade-off we're willing to make. Because again, we want to grow with you and manage as much of the wallet as we can.
I mean, it resonates as I am still thinking about however many thousands of dollars I have at my Citigroup 401k from when I worked there a long time ago. And I have to like print paperwork and fill out paperwork to do it. And like, it just does not incentivize me to keep it running and definitely not putting any more money into it. It's just not very user friendly. And it was the default. So I think that resonates to me. I love the focus on doing this And it also makes it harder, I think, for barriers to entry because if anybody is financially disciplined, you have to reach to a scale where you can really do this. You guys have seen the commitment to get through there, but it doesn't seem to be stopping you down. So in December, you launched an S&P 500 automated direct indexing fund. What does that mean, and why are you guys so excited about it?
Yeah, I think before I get into that, perhaps I can explain a little bit about tax loss harvesting in general, which is direct indexing as a form of. So tax loss harvesting allows you, when you own securities, whether it be ETFs or individual stocks, if you're in a loss position and you sell that security and take the loss, as long as you don't replace it within 30 days with the similar security, you can use that loss to offset income up to $3,000 annually or gains elsewhere in your portfolio. And so when you tax loss harvesting, what it allows you to do is you would sell a position and you would buy something that has a very high correlation to it so that you maintain the same exposure that you are trying to get, or whether it's an asset class or individual name. And then 30 days later, you can switch back into the original one, realize that tax savings, which is real cash flow, and add, a tax alpha to your return. So given that description, we actually launched with tax loss harvesting back in 2012 and coined the term direct indexing when we offered it in 2013. Direct indexing, the difference between that and what our tax loss harvesting is, it's directly done at the individual security level. So today, our standard kind of automated index investing account would primarily put you in ETFs, diversified, ETFs that represent indices on different asset classes. S&P 500 Direct allows you to own the individual constituents of the S&P 500. So you have way more opportunities to do tax loss harvesting because individual names have more volatility than diversified ETFs. What's interesting about the way we've done it, similar to what we discussed earlier, is we only charge 9 basis points in order to get access to this service, which will more than pay for itself in the first year that you use it. 9 basis points is the cost of the most popular ETF on the S&P 500. So you get the tax benefits while you also get the low cost savings. And our clients really find this useful because many of them are employed in tech or other areas where they're going to have gains elsewhere in their portfolio, and using these tax losses that are harvested in order to offset that will help them get a better after tax return.
Hey, we'll get back to the conversation in a moment after a word from our sponsors. All right. One of my favorite tools that I use and we use is Notion. Notion is used by thousands of startups around the world as their connected workspace for everything from engineering specs to new hire onboarding to fundraising. Notion has a special offer for listeners: 6 months of free Notion with unlimited AI, value of over $6,000. So you can access the limitless power of AI right inside of Notion to build and scale your company and team with one tool. Get 6 months free of Notion with unlimited AI, along with custom templates when you apply for notion.com/startups/puzzle. Once again, that's notion.com/startups/puzzle. Go for it. I think you all remember that sound. It's the dial-up. Why would startups still be using accounting software from the 1990s? It's like running your company on dial-up internet. It's like raising a Series A on a fax machine or pitching investors with a flip phone. You wouldn't build the next unicorn with outdated tech, so why are you still running your numbers on it? Puzzle is leading a new movement, an AI-first ledger that eliminates the grunt work, updates in real time, and actually helps you make informed decisions. No more waiting, no more guessing, just the clarity you need it when speed matters. This isn't just accounting, it's the future of how businesses run. Join the movement today at puzzle.io. Okay, so you can buy sort of the S&P 500, you can buy sort of an index fund, or you guys buy all the individual stocks and will trade that same exposure, same sort of volatility, but you'll optimize the trading and the balancing of these portfolios to maximize the taxless harvesting, as you call it, which means at the end of the year, you can potentially offset up to $3,000 of offsets against your income. Am I capturing it right?
Yep, 3,000 is the annual income limit that you can use tax losses against that you've harvested, but the amount you can offset your capital gains elsewhere in your portfolio, whether it's with Wealthfront or elsewhere, is unlimited.
Right. So you launched this, and how's it going?
Yeah, so actually the month we launched it was December of 24, and that quarter ended January 31, 25. Our last fiscal quarter of our year was our best month ever for net deposits in company history. And that was a big contribution to it was this product launch. So it's doing very well.
25% of your investment deposits were for a brand new product that you just launched in that same month?
That's right. Yeah.
Wow. So sort of just shows you that the right product at the right time can really, really become such a massive changer, even at the size and scale of something like Wealthfront, which is pretty crazy. I very find the world is like, if you build it, they will come. And that's like a meaningful amount of deposits. How does this happen? And I noticed you didn't use the word AI in here yet. This is just like you're actually just creating real value in society, not using AI.
Yeah. Well, I guess that helps answer your question, right? I mean, if you think about it, we've created way more value for our clients than, we've essentially created for ourselves. So tax loss harvesting since inception, we've harvested over $3.4 billion of losses for our clients, which we estimate has saved them $1 billion in taxes.
Hmm.
Similarly, because our advisory fee is a quarter of 1%, which is typically what the average advisor would charge, we've saved our clients about $1 billion in advisory fees as well. And the last thing is because we pay way more, 10 times kind of the average savings account on interest in your cash management account, we've paid our clients over $3 billion in excess interest since our cash management account was launched. So that's about $5 billion of value that has been shared with clients. And that's kind of how it happens. That's why they come.
But how on the initial product launch, do you press and then it happens? Or are you cross-marketing to your just existing companies? Are you seeing inflows?
Oh, that's a good question. That actually is for Wealthfront. We do find, especially now with 1 million clients, very high quality clients, we find that we typically start and can tell if we have a very good product by the adoption of our existing clients, especially because of the word of mouth growth that we typically use. And so, yeah, a lot of the initial account openings and funding will come from our initial or our existing clients, and then we do a lot of research and talk to them and learn what did they understand, what didn't they understand. People who maybe went into the flow and didn't finish it, people who are very happy with the product and have turned on a weekly recurring deposit, and try to understand what they liked about it so that we can help better message it and go more broadly with it.
I take that back. Like maybe it is a if you build it, they will come type of thing, which is I think this is also not the only product you launched last year. You also did an automated bond ladder. What does that mean?
Yeah, so bond ladders, it's quite interesting actually, and this is I would say a pretty good specific example of learnings that we've had over the years because we launched bond ladders in a period of time where there was a inverted yield curve, meaning you didn't get paid for taking duration risk, for extending your maturity out. You actually got paid more to be in the very front end of the yield curve than you would if you spent more time, which is not the normal yield curve environment. And so, but we knew that we needed to have a product for an environment where we were transitioning from higher rates to lower rates and the yield curve would normalize. And so bond ladders is essentially a portfolio of treasuries that we directly buy at different maturities, and treasuries are exempt from state income tax. So we will optimize based on your maturity needs a portfolio of treasuries that we'll put in a ladder. And as one matures, you can either extend the ladder again, or you can use that income to pay it, an expected, you know, cash flow payment. So I have one, for example, for my property taxes here in Texas. So I know on January 31st, I'm going to have to pay property taxes. I have a good idea of the amount. Why not take advantage of the most of that cash while it's waiting to be paid? And so I do a bond ladder, which again, it's also exempt from the state income tax, which for me is not a big deal because I'm in Texas, but many of our clients are coastal and will face the state income tax.
The coastal penalty. I get it. Can we talk a little bit about two things just really quickly? I know we're not going to solve this, but can you, for people that don't, you mentioned two things, and I wonder if we can sort of help articulate them to make it more clear for people that aren't fully understanding. One is the yield curve, and the other is what a bond ladder actually means. What does the yield curve mean? You talked about the inverted yield curve.
Yeah, the yield curve is if you essentially plotted the amount that you can earn on a fixed income treasuries, government issued debt at different maturities. So you would, 3 month, treasury bills, you have 1 year, 3 year, 5 year, 10 year, 30 year. And if you essentially plot the returns across, on a particular day like today, and you said, okay, the 1 year is paying 4% and the 10 years paying 4.3 and the 30 is paying 4.6, you would have a curve that's kind of upward sloping. What occurred essentially kind of once the Fed started raising rates is you would actually get, 5% at one point in, 3 month treasuries, but maybe like 4.5% in 10-year treasuries. And so you actually got more money for keeping, sorry, more interest for taking the short end of the curve, which typically shouldn't be the case. You should get paid for having your money, sitting out longer.
Yeah. And the ladder, is that something that is a strategy that you guys manage, or is that something that is a strategy that your customers have to manage on their own?
It's a good question. So no, what we've done, and this is again a perfect solution for Wealthfront to build, is to automate what is a very difficult and manual process if you try to do it on your own, or an advisor would charge a hefty fee to do for you. And so all you have to do in the app when you open a ladder account is essentially look at how you kind of have a slider that says, I need this money in a year, 2 years, 3 years, and you can see as you extend or shorten the time frame, the yield that we can offer changes based on what treasuries are doing that day, and you get to select it from there, and that's all you have to do. Then you can select whether or not you want to just continually roll it, and you get these beautiful notification messages from us that say, "Hey, you have a treasury that's going to expire on Tuesday. We're going to take that money and we're going to go ahead and buy you and extend the ladder as you've requested. There's nothing you need to do." And again, we do all of that for a quarter of 1%. And if you've ever gone to the Treasury Direct website, it is not easy to navigate. And additionally, learning fixed income like we just did with yield curve discussion, it's a whole nother, vernacular. Bonds have coupons, they have yields, there's maturities, on the run, off the run. Like it's a whole kind of, you know, another part of finance, fixed income, which we demystify and do all for our clients so they don't have to worry about that.
Well, so I'm going to ask the same question in two different ways. It's about what happens in the future for Wealthfront over the next 5 years. So, one anticipation is you guys will continue to identify killer products and sort of as the market changes, whether it's yields or economic or macro or global, I imagine there's a set of things that are top of your mind to do that. And you've continued to prove that for the last decade, and I'm sure you'll continue to do it. And the next question will be the same question, but like, how do you think AI continues to improve the industry and the business? Because for a period of time, we called them the robo advisors, and it was sort of this like automated investing based upon a set of rules. And one of the things that AI is really changing is the ability to provide context and changing context and dynamics. So I'd love to hear the same question both ways. How do you think about it sort of on a normal path? And how do you think about what AI is going to do to the industry over the next 5 years?
Yeah. And the first part of it, the more traditional path, I'll say, is we will be there with our clients, the millennials and young professionals, as they grow and their life gets more complicated and, different things occur with them. We're going to be there to offer them the products they need in ways they want to consume it, right? Digitally native via apps, all automated, kind of removing red tape and the demystification of things. Again, I think a lot of times in finance, things are kind of made confusing because at that point it's kind of easy to charge a high fee to get through that. Specifically to AI, I think you're talking mostly about large language models and their impact. But as a category, it's already had an impact on our business, and we've been using it for a while. From a machine learning perspective, for example, it's very helpful on back office, fraud and risk mitigation, identifying, you may have a good client model, bad client model. So if someone signs up at 2:30 in the morning from some crazy IP address and funds from a routing number that's sketchy, like the machine learning model will know that this particular transaction shouldn't just be automatically approved, or this particular client, it needs to go into a manual review that could be a potential bad client. So we've been doing that for a while. Large language models are very interesting, and I think you're right. In the future, they're going to have a really big impact on helping with the client experience, allowing them to ask questions that they can get answered right away, essentially with full context across, all that's ever been written about that topic. I don't think it's ready yet. We know that these models still hallucinate, and so you can't put them in front of a client, especially if you are regulated and you have, client's best interest in mind. But and you can, there's always the different things you could ask them to do. Like for a while, you could ask it how many R's were in the word strawberry, and it would argue with you that there were two when indeed there were three, and then it would change its mind. And so if it's not ready for that, it's not quite ready for prime time, but it's definitely in the future. The I think going to be very important to client experience and helping with education as well as other things in investing. But one thing that, you know, we don't think it will be able to do is provide excess returns for a very long period of time, right? Because just like anything else, when there's excess returns to be made, they eventually get arbitraged away. There's no free lunch even for AI.
I think one of the things when I think about Wealthfront for a long time, you guys have always invested in both content and design to help people understand how the industry works, how it works against them. And obviously, the outcome would be that it highlights Wealthfront's value proposition. A lot of that, I think, was done with these like really cool simulators and like projecting your wealth and what all these things. I imagine that AI, you guys will need to lead. How does AI change the interface of education from here are a couple settings and here's some visual designs and here's a set of things to sort of going through a little bit more nuanced question and answers in a way that probably wasn't scalable or viable before with humans, but probably will be now. So I'm excited to see how you guys continue to invest and sort of demystify a fairly opaque industry where a lot of we know the fees are made when there's something opaque or something scary like wealth building and our money. You guys have continued to do that. For founders and finance leaders that are listening, what do you think about as the most important compelling advice for them as they do it? I know that we hear a lot about people sort of like knowing they should do it, but not doing it because it's too hard or they don't have time or it's too confusing. We see a lot of people sort of get started and then sort of like just let it kind of set it and forget it. What's your advice for people that are hesitant to get started in proactively taking advice or proactively building their wealth? And then what do you advise for people that have got started? How often and how should they think about continuing to invest, evaluate, reevaluate things?
Yeah, I think for founders and finance leaders, most likely you have a very highly concentrated portion of your wealth in your company's stock. And that's not a bad thing. That's probably where a big liquidity event is going to be the majority of where your upside potential is. And you most likely have influence over that, being the founder or in the kind of finance lead position. So you're not going to get influence when you own, individual stocks of other companies. And so that's a good place to be in terms of your kind of majority of your upside in something that you have control over. But for the rest of your money, after you've saved up an emergency fund, like 6 months of, expenses if you were to, you know quit your job or whatever the case may be, the best way to invest, and this is time, tested over long periods of time, is what we offer, just a automated indexed investing strategy. And to your kind of question there, you wanna set up a recurring deposit. That can be up to the individual's preference. We have clients, like I said, that do it weekly, bi-monthly, once a month, and the most important thing that we like to say is it's not timing the market. People are always worried, am I buying high? Am I buying low? Timing the market is not important. It's time in the market because compounding, as we all know, is the eighth wonder of the world, right? He who understands it earns it, and he who doesn't pays it, as Albert Einstein said. And so it's very difficult. There's always fads, right? And you feel like you're missing the boat. Your friends on social are killing it with whatever the latest fad is. And so it can be very hard to stick with. But, there is overwhelming evidence that you can earn a very solid, consistent return doing something that is disciplined, like an automated recurring investment in index investing. And that's, why Wealthfront was created to help people do that in a way that takes a lot of the guesswork out of it for a very low fee, all because of software and automation. And so, yeah, I mean, it's simple and kind of the same advice probably we were giving 11 years ago, but there's a reason for that. And that's why it's been successful.
Nice. I love it. Well, on that note, I will thank you for joining us on the show. Thanks for sharing advice, tips, and tricks, both as a CFO, as a longtime operator, as somebody working really hard to help us all create a little bit more wealth and a little bit more security in our life. So I thank you, we thank you, and I appreciate your time.
Thank you for having me.
Thanks for listening to Tech Finance with Puzzle and Turpentine. If you got value from this episode, please share it with anybody building or funding the future of technology. And please leave us a review wherever you're listening and tell me about what you want to hear more of. If you're looking for accounting software you'll actually love to power your company, check out puzzle.io, the modern accounting platform for the AI era. Tech Finance is part of Turpentine, the awesome podcast network behind Econ 102 with Noah Smith, Turpentine VC, Complex Systems with Patrick McKenzie, and so many more.